money radio for a really great future. We're talking real money.
Thanks for keeping me company today as I try to keep you company today as we talk about something important today. That would be money. Your money and all those crazy little things you do with it. Some of them good, some of them not so good. We're going to try to help you. I, today, because Tom's not here, am going to try and help you avoid some of those dumb things that we have done and tend to do with our dough. And you are the person who makes it work because you give me the opportunity to answer your question. So I know what you're needing, wanting, desiring, and you do that by calling me at 855-935-TALK, 855-935-8255 every Saturday, because this will become a podcast next week. So if you're listening to the podcast, you need to call Saturdays, 855-935-8255 from noon to 2 Pacific time. And you can figure out what that is in your zone, I think. I'm pretty sure. Today on the program, we're talking about reactions. How we react and the things we should be doing when markets behave in a way that is uncomfortable for us. Markets are always volatile. The reason stocks return or have, everything's past tense, have returned decent money over decades, a century or more, is because they're volatile. They rise and fall in value depending on people's moods, feelings, perceptions, perspectives, expectations, but a lot of it's emotional. And so you're being rewarded for that emotional discomfort. That's what it is. And so you got to take risk to get returns, but there are ways to do it. And that's why we think it's so important that you deal with this. Shall I say logically? Sensibly, based on evidence, like real science, that kind of stuff. Stuff we sometimes want to deny because we believe in magic. There's no magic in money, none whatsoever. There are no special gadgets or gizmos that somebody's created that are going to make more money for you. And one of those broad categories of gadgets and gizmos are these alternative products that we talked about in the previous hour. I want to talk a little bit about now because recently it was announced that Blackstone, which is a big private money manager, has cut a deal with Vanguard and Wellington Management, which is part of Vanguard or worked with Vanguard, part of Vanguard, to create some alternative portfolios. As a matter of fact, the new fund is called Vanguard Alternative Strategies Fund. It's not traded yet, but it's new, and it's going to offer you those special investments that colleges use in their endowment funds and private money managers use in their hedge funds. These private assets that are so special, are purported to be so special. But private assets may not be anything special. And I want to talk a little bit about the downside of these private assets. There was a recent article in the Wall Street Journal by our good friend Jason Zweig, who's just brilliant. And there are a lot of private assets out there in the marketplace, and most of those are being held by giant institutions and endowments. Now, the problem with private equity, with private investments, they're often sold as non-volatile, but part of the reason for their lack of volatility is the fact that they're not priced every minute of every day like stocks are. We don't know what they're worth. We don't have a clue in some cases. They get to make up their values for some of these funds. They hire somebody to value them, and, well, is the value right? Turns out that the returns of many of these products have just plummeted, as there is now about $3.5 trillion, they say, in these private equities, but they don't know because they can't unload them because there are not any buyers. Now, what's the problem? If there aren't any buyers for an investment, what do you have to do to find buyers? Oh, yeah, you lower the price. We'll get to this more in a minute.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more detail.
Your guides to a really great financial future. Tom and Don are talking real money.
So to protect yourself against a downturn in the market, what should you do? Some people will tell you should buy alternative investments. Well, one of the reasons why they tell you that is because their expenses can be really high. Alternative investments have expense ratios, some of them that exceed 7% per year. That's ridiculous. You can't overcome that kind of a number. And what's really interesting about the private assets that everybody gets so excited about, according to this Wall Street Journal piece, through June 30th, 2024, the median endowment earned 6.7% per year net of fees, after fees. The S&P 500 net of fees over that same period made almost 13% with less risk. A balanced ETF made about 6% over that same period with less risk at a lower cost. So why would you want these? Well, my argument is you wouldn't. Somebody's going to have to sell them to you. Now, Vanguard entering that business, will that bring fees down? Yeah, but not as far as you might think. Vanguard's balanced index fund has expenses of 0.07% per year. The new Vanguard Alternative Strategies Fund is going to have expenses of 0.5, making it one of Vanguard's more expensive offerings. And is it likely to be worth it? Come on, really. It's just not. The 5-year average annual return for the index, the benchmark that Vanguard's going to follow for their fund, which is the comparable product out there, the 5-year. You think this is really good for you? 2.5% over 5 years per year. It's just pathetic, and you pay so much more for it. So, is there an alternative? No. Build the right portfolio for your risk tolerance and then keep putting money in it as long as you can. 855-935-TALK is our phone number. Let's go to Seattle. Brian, thanks for waiting, and welcome to Talking Real Money.
Yeah, I love what you're saying here. I've been investing in the market for a really long time, and a lot of people are really nervous right now. And one of my favorite quotes is from the Oracle of Omaha himself that says, when others are greedy, or be fearful when others are greedy, and be greedy when others are fearful.
Yeah.
And we're in that time right now. And I think, and I'm actually doing this, I'm loading up on every single fund that I can that is going to mirror the S&P 500 over the next 5 years. I'm not trying to make a quick buck. I'm not trying to even make money over the next 2 years. My horizon is 5 years. So everything that you're talking about makes complete sense and fits right into my investing profile, if you will. But anyway,
I hope, actually, let me just add something before we go on to the next thing, though. I hope two things. One, I hope your horizon actually is a little longer, because we could have a 5-year downturn. I don't guarantee we don't. The other thing is broaden your diversification beyond the S&P 500.
Yes. Yeah, well, and I 100% agree. I do have a small amount of money. I call my Vegas fund, where I invest in single stocks. And I do so because I'm willing to take the risk, and I'm also willing to play long term. But the expectation with that fund is it's not going to do as well as
no. But what I'm saying is do VT, do the Vanguard Total World instead of the Vanguard S&P. That's all I'm saying, because what it does is it actually smooths the ride, or at least historically has smoothed the ride. When the U.S. does badly, they don't always move in lockstep over long periods. So I would be more broadly diversified. But go ahead with your question. I'm sorry.
Got it. Yep. So 2 questions. One is, you're talking about returns and also the standard deviation, and there's an interesting metric called the Sharpe ratio.
Yep.
I don't know if you're familiar.
That's sort of a combination of those. Yeah, that's Professor William Sharpe at Stanford came up with that, and it's a measurement of risk and return.
Correct. So my question is can we use the Sharpe ratio across as just essentially a measurement across all of the funds that we look at to give us a better indication of what to expect? Absolutely.
The only reason we don't mention it is because we don't want anything to be the one standard by which people measure. And by the way, a Sharpe ratio of greater than 1 is good. Under 1 is bad. The higher that, the better the investment has done in the past on a risk-adjusted basis. I think I have that right.
Correct. That sounds right. Yep. Okay, that's good. I just wanted to clarify that. The second question it's a little bit fits into the conversation you've been talking about with alternative investing. I don't know if these fall under the alternative investment umbrella, but I've had a couple friends talk to me about structured products.
Yeah, no.
And they sound interesting because, okay, that was a quick no. Yeah,
you're talking about structured notes?
Yeah, structured notes. There's participation on the upside. There's limitation on the downside. Obviously, expenses are higher, but it on paper, it looked interesting. So I just wanted to get your thoughts.
Everything on paper, when it's being sold by someone, and by the way, these are Yield Street does these. I think Janus has one of these. They are very expensive, and again, they're designed to do something that can't really be done consistently, and that is give you upside with no downside. If you sacrifice upside, I mean, if you're trying to reduce downside, you are going to sacrifice upside. You can do that a lot. And my point is you can do it a lot less expensively by just buying a stock fund and a bond fund. And that's historically worked. Okay. See, these don't have any history. But stocks and bonds in a 60-40 portfolio have 100 years of history.
Right. And these alternative these structured products are based off of, in the back end, they're all made up of options, as my understanding.
Right. So it's all, and bear in mind, the cost of trading options is much higher than the cost of buying regular old boring securities. And their returns have not, we don't have enough history. We really don't have good history on any of these because they're new products. And you talk about quoting someone. Eugene Fama won the Nobel Prize for economics several years ago. Brilliant man. This is a guy who studied markets his entire life, University of Chicago, Booth School professor. And he said, I can't remember the exact quote, but in essence, he said, Wall Street comes up with a new idea every couple of weeks. He said the only new ideas that I've found, and I've seen 5 in 50 years. New ideas that actually work. So you can just blow off most of these things, because unless they are robust and prove themselves over a long period of time, your best bet is to ignore them. Thanks for the call. 855-935-TALK, our number.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
My favorite part of every single show is the time I get to spend talking with you. It's my favorite thing. I mean, honestly, I've been doing a talk show. I did my first talk show in 1985 on KVOR radio in Colorado Springs. And so I love talking to people on the radio, and thank you for calling 855-935-TALK, just like Rod did in Edmond. Hi, Rod. Welcome to the program.
Good afternoon, Lonely Don. I hope you're doing okay.
I am, sir. Thank you for keeping me company.
Well, speaking of the Oracle of Omaha on Brian there, I didn't know that was coming, but I have often admired, of course, the Oracle. But I was wondering if you could explain to us in plain language what exactly does the Berkshire Hathaway company, if that's the right word, what do they do? And should one have some of their stock in one's portfolio? And, I mean, given his reputation and such. Yeah. And, you know, maybe how much? Well, how many percent?
Okay.
That's kind of my question.
If you have a diversified portfolio already with using index funds, you already own Berkshire Hathaway in the exact right percentage. Based on
I wondered about that because I had not checked before I called you.
Yeah, for example, the Vanguard total stock market index has percentage of it has 2.5% of its portfolio in Berkshire Hathaway. So you already have it.
Okay, excellent.
The difference between Berkshire Hathaway and a fund is the fact that Berkshire Hathaway actively manages its portfolio of companies. It's very, very different, and it's very special, and it's not something any of us could emulate because we don't have the resources or the skill set to take a Dairy Queen, buy it, and then put money into it to turn it around and make it more profitable. Yeah. Or to take a Geico and then make it into a national brand. Those were all done by Berkshire Hathaway. They bought companies that Munger. I'm thinking of the Odd Couple because they are an odd couple. That Charlie Munger and Buffett bought together. They, along with a huge team of people who do valuations and spend tons of time studying them, they buy these companies. But they're not just buying them because they think they're going to be better companies. They buy them to make them better companies. So it's more like a giant conglomerate than a mutual fund. And I don't think Berkshire Hathaway will be the same when Buffett's gone.
You think they would have different?
I think that everything is different. I believe that almost every company, some manage to do better, but generally when you lose a leader of the skill set and the stature of a Warren Buffett, it is tough to continue to do as well because a lot of it was just his personal knowledge and gumption.
Mm-hmm.
But that's not saying I would get rid of it because I was a fool back when Steve Jobs died. And I told my wife to sell her Apple stock, but I didn't tell her to sell her Apple stock only because Steve Jobs died. I also did it because I didn't want her owning individual stocks. but you know, she sold it, and it did really well because Tim Cook ended up being brilliant in a totally different kind of way.
Indeed.
So you own it. I just own it the way you own it.
Yeah. Yeah, in that case, we own it in probably 2 or 3 different. My wife has some Vanguard stuff indexed, that very one, the total market, and I have a Schwab equivalent. I forget their call sign for that one.
Then you own it already, and you probably own about 2% of your portfolio in it, which is pretty substantial.
I would think so.
Or 1.5%, something like that. But it's a good percentage. So I think I'd just do what you're doing.
Sounds good, sir.
All right, sir. Thanks so much. Appreciate the call. 855-935-TALK is our phone number. That's 855-935-8255. It is anything that has anything to do with money discussed on the show. And investments more than anything else, but anything goes. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
You want some help with your money? Well, I'm here for you. I'm Don McDonald, and I'm doing the show alone this week because Tom took a vacation to Arizona where he basked in the sun until he went to see Carlos Santana last night, and then it rained on him. In Arizona. I know, hard to believe. 855-935-TALK is our phone number. That's 855-935-8255. And we have a lot of time left, so please feel free to call. Let's go to Ohio. Ed, welcome to the show.
Oh, thank you.
Hey, Ed.
It's nice to talk with you guys, and I really enjoy the show and all the wisdom you guys bring us.
Thank you, sir.
And I know that as a result of what my question, we should just stay the course and don't worry about it. But I keep hearing this noise about things like countries manipulating their currencies and manipulating interest rates. And I'm wondering, other than when I travel abroad, is that anything that really has any effect on any of us?
It depends. Okay, I got to be very careful not to deviate from into anything that even sounds political because I make people mad. But the reality is probably not. That's the simple answer. There has been currency and interest rate manipulation forever, for as long as there's been trade. I mean, the Chinese have manipulated their currency. We occasionally attempt to manipulate interest rates. We're not we're not blameless in all of this. The recent call for the Fed to reduce interest rates, that's an attempt at manipulating rates to artificially do something to the currency. The good news is it does not happen in a vacuum. We're all aware of it. So when we're aware of something, we can adjust our investing behavior to take into account the things that are known. And it's really, really hard to quietly manipulate trillions of dollars in currency without anybody knowing about it. Undervaluing your currency or overvaluing your currency. Although I don't know if anybody who really likes overvaluing it unless they're borrowing a lot. It's great to have an overvalued currency if you're borrowing trillions of dollars. That's why it's really nice for the U.S. to have an overvalued currency. Because it makes our money more attractive. But, in terms of currency exchange, unless you're trading the Forex, the time it really comes into play is when you're buying something from a foreign country or you're visiting a foreign country. If the Chinese yuan were to increase dramatically in value versus the dollar in an environment totally devoid of all the tariff talk, let's just talk pure currencies, the price of a Chinese manufactured good is going to climb if their currency becomes more valuable. So it's in their best interest to sell more stuff to keep their currency as cheap as they possibly can. If we want to sell more stuff to other countries, then we have to devalue our currency. But when you devalue your currency, you create inflation. And that's bad. Locally.
Hey, how does a country even go about trying to do that?
It's by playing the exchange markets, the exchange rates, by playing with interest rates. When you adjust an interest rate, if you want your currency to be worth less, pay less on your bonds. People aren't going to buy they're not going to buy the yuan to own yuan-denominated bonds if they don't pay very much. If you want people to buy your currency, then then you pay higher rates. It's a very complicated process, and again, in the grand scheme of things, because we have so many different currencies battling for preeminence in the marketplace, it's not easy to sustain for a long period of time either. It usually is something that happens short term, and then the marketplace adjusts those values once we know they're being artificially manipulated. The marketplace eventually decides ultimately what the dollar, the yen, the euro, the won, all of these are worth. Short term, you can manipulate them. Long term, the marketplace takes over. It's like the stock market. You can manipulate the price of an individual stock for a while, but the market's going to find out really soon and adjust the price of that stock.
Okay. And for those of us who are just the average investor,
meaningless.
Just noise, and we ignore it.
Yep. As a matter of fact, my best advice for a philosophy is most financial news for most people is worthy of avoidance. You don't need to pay attention to it. It's noise. 855-935-TALK. Give me a call.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
And we're stumbling over our words. Yes, we are. The royal we, just me, Don McDonald. 855-935-TALK is our phone number. That's 855-935-8255. I'm alone. Tom's on a plane. He should be back in Seattle again soon. And then we'll have him back on next week, and he'll join me. We'll be chatting together along with you. But for now, it's just you guys and me, and let's go to Seattle and talk to Mary. Hi, Mary. Welcome to the program.
Hello.
Hello, Mary, off there in the distance.
I am sick. So
You're a long way away from your phone. Where are you?
I am right by my phone.
It's weird. You sound like you're across the room.
I'm going to take you off with my Bluetooth speaker. Maybe
Yeah, I think the Bluetooth thing is weird. It's not sounding very good. We need to go back on the real phone.
Can you hear me now?
Oh, you're much better now. Sounds like you're right here with me.
Okay.
Okay, what's up?
Okay, I have a few questions. So you talk about fiduciary.
Yeah.
So I am 100% sure my investment advisor is not fiduciary.
Mm-hmm.
So would I have to switch out completely and get somebody who's fiduciary?
If you want someone who's looking out for you and not themselves, yes. But let me tell you how easy it is. Once you find, the hard part is finding a 100% fiduciary advisor, because according to a study done several years ago by MarketWatch, about 1 out of 100 financial advisors are always required to act as a fiduciary. So finding them is hard. Once you find your fiduciary, though, the fiduciary advisor can move the money for you. You don't have to do anything.
Okay.
You don't have to make that uncomfortable call to the person you've been working with. They just go grab the money and bring it over to the new account.
So how do I know this fiduciary person is good?
That's where the hard part comes in, where you have to do some research. And there are several places you can start. We at talkingrealmoney.com. If you go to talkingrealmoney.com/help, HELP, we have some resources to help you find Seattle area advisors that we know act as a fiduciary. We also have what we call an advisor interview form that asks really important probing questions to help you determine if they really are trying to do what's best for you. It's not about returns. It's about how they manage your money so that they manage it in a way that is most comfortable for you, that makes you the most money within your profile for needing and taking risk, and that they do it at the lowest cost possible. And that's where those questions come in handy.
Okay.
You can also look them up online. The Securities and Exchange Commission requires all registered investment advisors, who are the only ones who are always required to act as a fiduciary, and they have to they have to create what's called a ADV brochure, ADV Part 2, and you can find that online at advisorinfo.sec.gov, and you can read all about them. You can check out what they charge, how they invest, all that kind of stuff. So you need to do some research, but once you find one that you like, they'll do all the work for you.
So if I were to contact your agent, because I just look you up, if I will get all the steps. So it would be outside of Talking Real Money company, or whatever you call it.
Talking Real Money is a podcast that Tom and I created when we started our investment firm, which was Vestry. Vestry merged with Appella Wealth. Tom and I met with Appella Wealth, and we talked to them, and they agree with our way of investing. So they acquired our firm and this show. So we are paid for by them. They pay me to do this. But I'm telling you, I insisted that we not use this show as a sales tool. So I try to avoid doing that. But one of the things we do, and if you haven't done it, you really ought to do it, and that is just go to talkingrealmoney.com and meet with one of the advisors. You can even meet with Tom and just have him look at what, if you don't need us, we'll tell you don't need us. We'll just honestly.
You know why?
Why?
Since 2021, my investment has, because I'm looking at it from 2018 when I retired, and I moved it from my employer.
Your 401k.
Modality, basically.
Yeah,
right. Yeah.
What investments do you own, Mary? Can you tell me which funds you own in your portfolio, since you have it there?
Holy smoke!
Just give me a couple. Just give me a couple. It tells me so.
I will. This page doesn't tell me. It just says additions. Hold on.
That's all right. Take your time.
It's here. Okay.
It's going to be there.
Global Class.
What was it?
Jensen. First Eagle Global Class.
Oh my goodness. Okay, go ahead. Give me a couple others.
And then Jensen Quality Growth Fund, Parnassus.
Parnassus. Okay, yeah, that.
T. Rowe Price Capital. Vanguard Emerging. Avantis International Small Cap. Swap Strategies.
Okay. Well, actually, let me tell you, this may very well be. What was the name of the Parnassus fund? Let me just use that one. Parnassus what?
Let me see. Parnassus. Let me see. I'll just go back to the page.
Yeah. Just give me that.
It's a core equity.
The core equity. Okay. I see. Institutional. Core equity institutional fund. See, here's the thing. They're using actively managed, very expensive funds. So while they may be a fee-only advisor, I don't think their advice is very good. So, yes, I would absolutely, positively suggest you go to talkingrealmoney.com, click the button that says Meet an Advisor. Here's the one thing I'll promise you. They'll be honest with you. They will tell you what they think of your portfolio, how it compares to what we might do or somebody else like us might do, how much they're charging you, and whether this is likely to work for you. And then if you did hire us, we would start to rebuild this, because I can tell you just from the few funds you've named, there are a couple I like, but there are many more that I despise. I mean, that Parnassus fund has an expense ratio of 60 basis points, which in my opinion is just ridiculous. And I don't know that any of these are giving you the kind of performance that you would expect from higher funds. I mean, they're not bad, but they're expensive, and I don't know that they're doing that much. But you really need a review. You need a full-fledged review. So just go to TalkingRealMoney.com, hit Meet an Advisor. If you want to talk to Tom, just say, I want to talk to Tom on that form, and Tom will call you. You'll talk with him directly. And I really appreciate your call and wish you well. And I think you could, I know you could have a better portfolio. But at least your guy is not terrible. I got to tell you, I don't think he's terrible. Yes, ma'am. What else? Real quick.
Can I ask you one last question? Yes. Why would I pick Tom versus Don?
Oh, because Don doesn't do the meetings. Only Tom does the meetings. Don is the guy who's creating the podcast. I work all day on building the podcast. Tom works with clients. He just comes on with me on Saturdays and does the podcast with me. So he has more time, and he's much better at it than I am. Thanks for the call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
All right, we have a little bit of time left and one call left. Helen, it's your turn. Welcome to Talking Real Money.
Hello.
Hello, Helen.
Okay, I have two questions.
Yes, ma'am.
Hello. I have two questions. I'm thinking of doing a 7-digit financial decision. Now, this is kind of a big deal.
It is, yeah.
I have heard about this reverse mortgage, which I know had a bad reputation in the past.
Yes.
And supposedly that has changed significantly. I've got my notes, so I'm kind of reading. And the reverse mortgage can be stopped, is what I was told. Mm-hmm. And what is the good, bad, and ugly of this financial decision?
Well, they're expensive.
It's going to be used. Okay, it's going to be used to do necessary things as a result of embezzlement, and I have zero hope in getting legal justice.
Okay, so you have money. You need to replace some money that you had before that you don't have anymore. And apparently,
I'm going to borrow against the property.
Yeah, you have a house that's worth some serious money, right?
Yeah, buildings.
Oh, other buildings. Oh, well, a reverse mortgage has to be against your primary residence.
Oh, you can't do it.
No, but do you have other properties?
Well, that's what I'm. Yeah.
Why don't you start
rentals?
Why don't you sell some of them?
No.
Why?
I'm responsible. Well, for one thing, once they are upgraded, the income for the rest of life will be very good.
Okay, but you don't have the money. You don't have the money to do that. How much equity do you have in these properties?
100%.
So they are completely mortgage-free. Well, then why don't you take out a mortgage on one of those properties or two of them and use that money to get them to where you need them to be and replenish some of your embezzled funds?
Well, and I'm not sure how much that is because there's major repairs that need to be done. And once they're done, I'm trouble-free as far as upkeep.
Yeah. Are you doing, is this a business? Is this a business you own or something in which you're doing this?
Yeah, yes. And I'm going to ask this question because we're getting, is it true that a trust protects property from somebody setting up an estate as part of the embezzlement?
It is distinctly possible that it would. But that is a question for an attorney. But my concern is, how old are you?
76.
Roughly. How old? 96? 76. I said 96. You sound really good for 96. I got to tell you, if I was in your shoes, I'd be selling a piece of property because it sounds like they're not great properties. But thanks so much for the call. We're totally out of time.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.